Welcome to the Millionaire Mindcast, where we broadcast weekly interviews with millionaire minds from across the globe to empower you on your journey of unlocking a rich and fulfilling life. It's time to unleash your millionaire within. Now, here's your host, Matty A.
What's going on, Millionaire Mindcast fam? Welcome into today's show. I got two badass guests for you guys here today that are going to teach you all about building wealth in real estate, specifically in apartments. Whether you want to be an active real estate investor and buy these apartments yourselves and manage these apartments yourself, then you're really going to want to listen to this episode. But even if you're somebody that just wants to build wealth in real estate, and you may want to invest in other people's deals, in other hedge funds or REITs or investment opportunities in apartments. This is going to take you literally from A to Z. All of the things that you should be looking out for, what you should be researching, how you should be analyzing deals, how do you structure them, what are some of the common mistakes that people make, what are some of the big opportunities that people are overlooking or capitalizing on. All kinds of amazing content here today on apartment investing. If you are new to the show and you haven't subscribed yet, be sure to hit that subscribe button on whatever platform you enjoy listening to this on, and know that all of our Millionaire Mindcast episodes now are on YouTube. So if you want to see that face for radio, head over to the Matt Aitchison YouTube channel or just type in Millionaire Mindcast and you'll find all of our Millionaire Monday interviews with me and my guests. You'll find our Wealth Building Wednesday interviews with Ryan and I, and you'll also find my Friday Food for Thought solo episodes on there as well. So if you're not subscribed to the YouTube channel yet, be sure to hit that subscribe button. Drop me a comment below. If you're watching this right now on YouTube, say what up, drop me a comment, and also be sure to head over to go.millionairemindcast.com. That's go.millionairemindcast.com to enter a question. And by entering a question that you want answered on the show or in one of our episodes, you get automatically entered into winning over $1,100 in prizes that I give away each and every month: gift cards, planners, courses, books, coaching calls, all kinds of great stuff. So head over to go.millionairemindcast.com for that. And if you are new to the show or you're a returning listener and you haven't said what up to me yet, hit me up, text me at 844-447-1555. So be sure to take some great notes today. Again, especially with the times that we're in right now, you should be skilling up in something. Real estate investing is one that I highly recommend, being that it is one of the most proven, practical wealth building vehicles on the planet that has been tried and tested. And know that we are heading into a real estate recession. It is coming. We don't know how hard it is going to get hit, but as we speak today, we are heading towards a real estate recession, and there's going to be massive opportunity in this wealth transfer. Because wealth doesn't go away in times like we're in right now. It just transfers hands. It goes from one person to the next, one entity to the next. And I want you guys to be able to take advantage of that. So knowing opportunities like real estate are going to be coming across your plate or in your ecosystem with maybe other people that might be doing it, you want to start, one, learning the skills and the knowledge and the strategies, but you also want to be putting out the narrative that you're looking for those opportunities with other people that might be interested in finding them for you. So with that being said, we talk a lot about some strategies, some tips, some tools that you can, one, learn, but also be implementing and sharpening the axe on as we get closer and closer to this real estate crash. So with that being said, be sure to shout out Jake and Gino on any great insights, information that they have on your social media. Share this with a friend or a family member. If you haven't left a review and you get some value from today's episode, all I ask is that you leave a review. And without any further ado, let's continue that march to $1 million and beyond right after this quick message. Are you ready to quit talking about your real estate investing goals this year and start taking the necessary actions to make them a reality? If you're truly serious about leveraging the vehicle of real estate to build wealth, to generate passive income, to unlock financial freedom, then working with a coach is the missing link. If you want to avoid the mistakes that most people make, you want to accelerate getting the results, you want to shorten your learning curve without having to figure it all out on your own, then sign up for a free discovery call with me today to discuss how I can help you getting there. You can do that by texting the word mentor to 844-447-1555 to set up a call time directly with me. I will be working with a few committed investors, serious investors who are ready to take their real estate investing goals to the next level this year by giving them complete access to myself, my team, my network, my resources, and all of my business systems. And if this is something that you are interested in, don't wait. Set up a call today. Text the word mentor to 844-447-1555. Well, I'm excited to welcome into the show Jake and Gino. What's up, fellas?
Matt, how you doing?
Hey, thanks for having us, Matt.
I'm not usually blessed with two badasses on the call. Usually it's one-to-one. So anytime I can get some brilliant minds in one space, it's always a good day. Selfishly, and I know our guests, our listeners really appreciate it. For many people, this is a question that I always get asked hey, I'm starting to build wealth in my business and I want to start diversifying, whether that's in equities, whether that's a lot of people obviously are heavy and bullish on real estate in our community. They don't really know where to get started. And I know both you guys have a really cool story. And for people that don't know your backstory, how did you guys get into being this juggernaut of multifamily real estate syndicators and investors and educators that people now see you guys as today?
Well, Jake and I met in 2009. He was a drug rep. I had a restaurant in New York. We both were struggling. We liked what we liked what we're doing, but we knew there was a ceiling. I mean, I was stuck at the restaurant and Jake was stuck at a W-2 job. So fast forward 2 years, it's 2011. He's sitting in the restaurant and he's like, I'm going down to Knoxville, Tennessee. I swear, didn't know where Knoxville, Tennessee was on a map. I said, Knoxville, really? And I didn't know. Right? What you don't know, you don't know.
Right.
I come and find out. We whip out the laptop. We're looking at LoopNet, and I'm like, well, there's some deals down here, Jake. And I had been coaching. So the first step for everybody wanting to get into any endeavor, whether you're going to do crypto, whether you're going to get into single family, whether you're going to get self-storage, you need to find an educator. You need to find a mentor. You need to find somebody doing in the space that you want to emulate. And that's what I did. I had gone to a couple different coaching programs and a couple different mentors pre-2011. I was working my way up. I was getting my muscles because I had gotten burned in a couple deals before that. So Jake moves down in 2011 by himself. He leaves his fiance in New York, everybody. So it's not easy. You're going to get punched in the face. He leaves, and I say, Jake, when you get down there, let's start looking at deals. So, we're a little rough with the brokers. We didn't know how to build the credibility with them. It took us 18 months to find the first deal. In the meanwhile, while we're looking, Jake's fiance moves down. They get married. He buys a house. We put on hold. But that burning desire was always there for me. So 2013 in February, we bought our first 25-unit deal on LoopNet. At the time, market sucked. There were a lot of deals. There was no money, 1% GDP. Rents were low. Consumer sentiment was low. And it's never the right time to get into it, Matt. The only time to get into it is when you're ready to get into it, when you're fed up with your job, when you're fed up with whatever, and you're just, let's burn the ships. One other bit of advice I give everybody, my buddy likes to say it all the time, stay in your lane. If you're going to do something, if you're going to trade crypto, own it. Go out there and learn it. Give yourself a good 6 months to learn the space. For us, it is 18 months on the job training before we got that first deal. And the momentum from that first deal, 3 months later, we bought our second deal. And 6 months later, we bought our third deal. So don't go out there worrying about where am I going to find the money. Just learn the space. Learn the three pillars, the buy right, the manage right, and the finance right, and then everything will start falling into place. Money will be attracted to you. Deals and opportunities will be attracted to you. We had a podcast this morning and some lady was talking about the reticulator activating device in your brain. We call it the flux capacitor. All of a sudden, those opportunities start coming to you because you start focusing on opportunities and you start noticing things out there and the momentum takes place. And all of a sudden, you have one investor dinner and you have another one. And then all of a sudden, you talk to a broker and then all of a sudden, you start underwriting deals and things start happening. So you just need to really focus on what you want, focus on why you want it, and then just start going out there and start making it happen.
Yeah, Matt, I think the most interesting thing about what you just said was diversify. And you were talking about people making money and then what do they do with the money? They want to grow their wealth. And the great thing about multifamily is, as Gino and I both believe, is that it's the right vehicle. So I think latching onto the right vehicle, doing your research, and not getting that shiny object syndrome has led to so much of our success. Now, that doesn't mean if you're a doctor, you're out there crushing it right now, that you should invest with us, or you should invest with a great, multifamily sponsor, because we believe it's the right vehicle. But diversifying for us, maybe a different market, maybe a new deal to put our money in, because we love multifamily for the simple fact that it's a basic human need, and the demographics say this is the place to be. So I think the most important thing right now is uncovering value and finding the right deal. And we diversify by adding more assets and different businesses around the multifamily space. And that's really been a shortened version of our story.
I love it, man. Makes sense. And it's cool because you guys started from, W-2 to going, hey, we see some opportunity here. We're going to sharpen our axe here. We're going to skill up in this area. We're going to surround ourselves with the right people. We're just going to get in the game. And obviously you guys have built a massive portfolio, and you got an amazing team around you. You guys got amazing brands. I'm curious, we were in Aspen, Colorado at the Go Abundance event recently, and they had this panel on bulls and bears in regards to multifamily real estate. You guys are obviously bullish on multifamily real estate. If we're talking in the long, extended timeline of investing in this vehicle, in this asset class, why do you see multifamily real estate as such a safe, steady Eddie, great investment vehicle for people to look at and pay attention to when they're talking about growing their wealth and their passive income and their net worth moving forward?
So Matt, I always tell people when they want to learn about demographics, read the book Big Shifts Ahead by Chris Porter. It's an excellent book on demographics, on what's going on. The 2008 recession really burned a lot of people. I think 30% of the single family homes went off market. They went to rentals. So the first thing is people are not buying homes. The millennials have too much student debt. They're prolonging getting married and having families. So what happens is people who have families who get married are the ones who buy homes. So millennials have 1.6 trillion in student debt. We have 72 million millennials, and we have about 72 million baby boomers. About half the population fall in those two demographics. They're not buying homes. They're deferring, and they're renting, right? And why would they? If you can pay all in $1,500 a month for a 2-bedroom apartment, not worry about it. Turnkey, hot water heater breaks, I don't have to worry about it. We all know that a home intrinsically is an asset on the balance sheet, but it's a liability when it comes to taking care of it. And unless you're a sucker like me who has 6 kids and you need to buy a house, right? then that's a different story. But if you don't have that, you don't have to worry about it. It's really a luxury. Cars and homes are luxuries, and I think people understand that. So demographically speaking, it's so much easier to rent, and I think people are renting that way. Going long term, why I think multifamily, the affordable housing crisis, there's 100,000 units coming online. We need 250,000. There's really a big shortage in apartments. The next one is the immigrants. A lot of immigrant population, they tend to rent out there. You have a lot of women that are getting jobs and college degrees. There's a lot of single women. They tend to rent also. So if you look at that whole renting population, they're the ones out there that are renting. So I think you have to look at that. Looking at the flow of money coming from overseas, whether it's Asian money. You see what's going on in China with the coronavirus. That people want a safer haven. And I guess they're perceiving the U.S. as a safe haven, because if you look overseas with negative interest rates, with economies that are just, flailing, ours is actually doing relatively well. You wouldn't know. So I think we're a safe haven. And I think multifamily, like Jake said, it's food, clothing, and apartments. We need those 3 basic human needs, and we fall into one of those 3 basic human needs. And if you can treat it as a business, not just as a landlord, I think people will really gravitate towards it. And you'll see that going into the future, going forward, it's going to be necessary. It's going to be a human need, basically.
Yeah, and it's fun to have these debates, but it's such a localized question. You want to get up there and you're at these conferences and you're kicking it around. But really, for me, it comes back to, is that population growth there in the market that you're operating in? Mm-hmm. Are you buying the deal right? So we have a 3-step framework: buy right, manage right, and finance right. And I think multifamily is a 3-legged stool. And if you screw up any of those legs, it may not matter. I think ultimately, if you overpaid for the deal, you might be screwed. If you can't manage the thing, you're in trouble. And if you don't finance it correctly, you could get burned as well. We like long-term fixed rate, non-recourse financing. We're a vertically integrated organization, so we manage our deals in-house ourselves. We're constantly looking at the KPIs, tweaking things, trying to make it better. And we treat multifamily as the only business. We don't do anything else but multifamily apartments. So it's highly focused on operations and making sure we're kicking ass. And look, you could still miss on the underwriting side. Everything's really expensive right now. It's hard to find the deal. We only did think, what did we do? 2 deals last year, Gino? Maybe
That's
two,
it, 2.
3. And it was because, look, we love the space, but we want to make sure that we're putting our money to work in something that we really believe in. And that means it's got to be a solid deal.
And I think, Matt, the reason why we only did 2 deals is we're looking at the bigger units, 100 plus. There's a lot of opportunity in the smaller fragmented units, whether it's 10 or 20 units, these mom and pops. The large ones, you have private equity money coming in. You have money coming from Asia. The cost segregation and the tax benefits are one of the big draws that with multifamily, and people are taking advantage of that. The smaller units, a lot of our students have closed over 5,000 units. So far. So our students are buying those small deals, and they're getting those small deals. Once you get into the small deals, you can start gravitating into those bigger deals. Think big, start small. That's my mantra. That's what we did, because you can figure it out. You're managing a 15-unit property and doing 3 apartment turns. You can handle that. But if it's on your first deal, you've never done it before, and they're all telling you to buy 100 units, you buy 100 units and you have 25 vacants, that's going to sink your ship a lot quicker, unless you have partners who have experience. So, but for us, we started with 25 units. It was manageable. We had septic fields go out. We had somebody pass away in a unit. We had weekly renters. We had bed bugs. But with 25 units, it was still big enough where we had some type of economy of scale. But at the same time, we could actually manage
we learned a ton
and learn. Yes.
Yeah, that it's kind of that baptism
the school of hard
by
knocks.
fire. Yeah, exactly. And like you said, your upside's still there, but you're not falling as far if you're making some of those mistakes. And you kind of talked about it. For those people that are interested in investing in multifamily real estate, when is the right time? Well, now, yesterday, as long as you're doing the right things, right? And underwriting properly, structuring deals properly, surrounding yourself with the right team, the right operators. Why? You talked about some of the things that you guys are really paying attention to in regards to data and metrics and demographics. Let's talk about the how a little bit, and there's a lot of different ways of participating in multifamily real estate. What are some of those for people that are thinking, oh, do I have to have hundreds of thousands of dollars and be the operator to, buy 100-unit property? Or what does the participation look like for people that are looking at this vehicle as an investment?
Well, you can be like Jake and Gino and be dumb like we were in the beginning and just think, hey, I'm going to get in and buy my own stuff. There's nothing wrong with that. We love that option. Our first 1,000 units we just bought with me, Jake, and a partner. So the first 1,000 units were ourselves. We were able to refinance over $9 million and put it into the next deal. So the first 1,000 units was not syndicated. It was owned ourselves. And was it hard? Yeah, it was really hard because we had to use community banks, and then we had to refi into agency debt. So there's risk on there. So it was what we would call a contingent liability or recourse loan. And everyone says, well, isn't that risky? You've got to start somewhere. I'm signing on the dotted line. I'm going to pay the loan.
Risk for me was staying in my job and going to get laid off. Okay?
Exactly. That was right.
Yes.
Risk is all contextual, I think.
That's right. Exactly. So that's one way to do it. Partner up with other people. Buy your own deal initially. You can start that way. The second way is owner financing. We owner financed our first deal. We were able to get 10% owner financing. We only needed to come up with 10% of the down payment. We also owner financed a 281 unit, $11 million deal with all owner financing. So that's another option, another way for you to get into. Get creative. The other way to do it is start syndicating, start raising capital. With us on our first deal, we started small. For us, our first syndication was 132 units. It was a $6 million deal. We could have bought it internally, but it's that point in life where we said, let's rip off the Band-Aid. Let's see how syndication is. Everyone's saying it's this wonderful tool, wonderful device. And you know what? It really is. For the right deal, for the right structure, for the right strategy, for the right time period, it's an awesome strategy for you to lever up to get into bigger assets that you can't take down by yourselves. That diversification that you just spoken about. We bought a $15 million deal. We probably wouldn't have been able to buy it by ourselves. So, hey, bring on some partners, lever up, get those economies of scale. So for us, syndication is another way. And for you, everyone out there, if you're syndicating a deal, you need partners when you're syndicating, whether it's people who can help you raise capital, people who are going to do, are going to go out there and actually be boots on the ground, actually do day-to-day property management. People are going to be out there, maybe they're going to be the net worth or the KPs on the deal to bring some of that balance sheet, or they're guys out there who are going to find the deals, underwrite the deal. So there's so many different tasks within a syndication that you can pick which one you like, and that's another way that you can start.
Or invest with somebody, right?
Yeah.
Go invest and learn on someone's deal.
Right.
Mm-hmm.
I was going to say, for people that aren't familiar with what a syndication is and what that could look like for them being directly involved or maybe passively involved, talk a little bit more about that.
Yeah, so with the syndication, there's two parts, the limited partner and the general partner. The general partners are the guys like Jake and Gino who are the sponsors of the deal. We put the deal together. We find the deal. We'll underwrite the deal. We quote unquote will asset manage and or property manage the deal. And we'll be split it up. There'll be a co-promote between a percentage going to the limited partners and a percentage going to the general partners. Now, traditionally, the general partners will put maybe 10 or 15% down on the deal, and that's it. And they'll get X amount of the deal, let's say 30% of that deal. The limited partners will get the remainder of it, but they'll have to bring in the vast majority of the capital. Now, the difference is the limited partners are limited to the risk of that deal. So if that deal craps out, they only lose their money. So if Matt comes to Gino and says, I want to put 50 grand in your deal, okay, Matt, we lose the deal, you lose 50 grand. The general partners are the ones who are signing on the debt, who are taking the vast majority of the risk. And I said to myself, that doesn't sound fair in the beginning. The GP's not bringing money, but they're signing on the debt and they're doing the work and they're finding the deal and they're managing the deal and they're doing the monthly webinars and they're doing the monthly draws and they're talking to the property management company. There's a ton of work involved. So like Jake had mentioned, become a limited partner on a deal. Find a sponsor who you really like, learn how to underwrite the deal, learn how to underwrite the market, and maybe you put a little bit of capital with that company, invest passively with them and see how the process works. And you're earning while you're learning. That's a great way to start out.
What are some kind of rules of thumb that if people are looking at participating in a limited partnership capacity as an LP, what are some of the returns that they should be looking for? Good rules of thumb that a good operator or sponsor will be offering them, maybe things that are red flags they should be paying attention to?
First thing is the sponsor. You want to have a sponsor. I would rather have a great sponsor and a marginal deal than have a marginal sponsor and a great deal. Sponsors have to be transparent. I think they have to have some type of credibility. I mean, we already had 1,000 units under management. I think the other key is if you can find a sponsor who's vertically integrated, who actually manages their own stuff, it's really great because they're in control. They know what's going on the front lines. Now, there's nothing wrong with a company that's syndicating a deal that doesn't manage, but if there's a difference between two, I'd rather get the vertically integrated company. As far as out there, I think you want a sponsor who's transparent. We're doing monthly webinars with our investors. We do monthly emails. We send out quarterly newsletters, all that. You want to get in front. You also want to know why the sponsor is investing in the deal. You want to know what kind of markets they're investing in. As far as rates of return, I mean, right now we're seeing 6 to 8% preferred rates of return on deals, depending on the type of asset, the quality of the asset, what if it's an A property, which is really brand new, B or C, it depends on that. So it's between 6 and 8%. And the splits, I mean,
Gino's talking cash on cash, not
cash on, yes.
IRR. So, right?
Yeah, cash on cash. IRR is 15%. I mean, some people will tell you 20, but in this market, I mean, between 15 and 20, that's what you're going to see traditionally now in this type of the market cycle. So other things, probably 70-30, co-promote 70% to the LP, 30% to the GP. That might go 80-20 depending on the experience of the sponsor. Some sponsors do a 60-40, but if they're going to get you a 20% IRR, does it really matter that you only get 60% of the, you're still going to get the return. But I think it really all falls back on the sponsor and the way the sponsor can tell the story and why they're investing, for instance, in Orlando and why they're buying this property and how are they going to fix this property up and add value. I think that's what you really need to look for.
Yeah, I think two other things similar to the education side of our business is that we wanted to prove it first, and we created a framework by doing, and we documented everything along our journey, and that's where our education business came from. But on the investment side of it, you want someone that's going to have skin in the game. Like for example, we proved our model with 1,000 units, and we documented that, and we were very much controlling the entire process. And then when we go and do a syndication, we have a large amount of money at risk in that syndication as well. And so I'm not saying that's like a reason why you should invest with us, but if you're looking at a group to invest with, make sure that they have some of their own money on the line as well, because I think that no one's going to take care of it, or care as much as an owner, a true owner, and you want that sponsor to have true ownership in the deal. And I think that's something that is, you should look for time and time again in that proven track record. So
we'll switch it up a little bit and talk about the active investor that says, I think I can go out and find a deal. I don't want to do it passively. I want to kind of take this bull by the horns. What are some of the best lead generation efforts and ways you're seeing your students and you guys having a great track record have come across and found deals in the past and obviously in today's current climate?
That's a great question, Matt. I think the first thing that you need to do is you need to select the market. You have to be all in, especially when you're first starting out. You can't be spread out into 3 or 4 different markets, only because when you first start out, you need to make connections. You need to meet brokers. Brokers are the gateway in multifamily because it's not like single family. There's a lot of off market or pre-market deals. If you have relationships with these brokers, they're going to bring in the deals. Brokers want closers. Brokers want you to close in a deal, whether it's a 10 unit or 30 unit. If you say you're going to close in a deal and you quote unquote are a retrader, someone who's saying, I'm going to, I want money closing, I don't like this, they're not going to want to work with you. So you need to create those relationships with brokers. The second thing is start going on property tours. Start looking at deals. If you're in California and you want to look in Texas, you need to get on a plane and you need to go visit those markets, and you need to make face-to-face with the brokers, because there's a lot of investors in California picking up the phone, calling brokers in Texas and saying, hey, you have any deals for me? They can't waste their time with you because they've got other people out there going out there and being serious. So to show your seriousness, get out there, get on planes and start doing property tours and show the brokers that you're serious. And I think the next thing, on our website, you can get our credibility book. I think you really need to create a credibility book, which is basically a business plan of what you're going to do. On ours, when we first got our third deal, it was a real big stretch for us. We had 50 something units under management. It was a 136 unit deal. We created a credibility book that documented our first 2 deals, documented why we were in Knoxville, gave our strategy of refine roll, talked about what we were going to do with this 136 units. It was a basic business plan. We called it the credibility book. Jake is at the table with the banker, slides it over, and the banker's like, I've never seen this before. Prepared. So if you can bring that out, show your investors, show the real estate brokers, show the mortgage brokers, that will give you a leg up. So I mean, you can get that at jakeandgino.com/honeybee. Just download the credibility book and it'll give you an idea. Just take a look and see how it's built out. You can create your own. Whether you have 100 assets, you have no assets, it doesn't matter. It just lays out what you want to do and it lays out your business plan, and it'll give the broker a sense of what you're looking for. We look for mom and pops. So when brokers see that, they know exactly the type of assets we're looking for. So
yeah, I love there's another one that we're waiting to connect on, and I'm going to throw this one out there, and it piggybacks off what Gino said, and that's the drop-in. There's some deals locally that we want. I've been going around with some of the guys on the team recently, and we're actually taking the credibility book, maybe some. All right, I'm going to backstory a little bit here. So back in my pharma days, it was always cupcakes and little boy voice. You might be saying, what the hell is cupcakes and a little boy voice? Basically, my whole shtick was, I wasn't going to go try to browbeat the doctors and the different people that I was calling on. So I tried to build rapport. Jeffrey Gitomer 101. I would bring like these really massive cupcakes or treats into the office, and I would talk with a little boy voice, like, hey, Doc, how you doing today? And I want to be very approachable because I was a little bigger at the time. I was probably like 210. That's kind of a meathead, and I didn't want to go in like freak people out, right? Can get a little heated. So I went with the cupcakes and little boy voice. So we've been trying to duplicate this strategy on owner drop-ins, and we've been going in the market, get some cupcakes, maybe some company swag and credibility book, and just doing some drop-ins, saying, hey, you may not be ready to sell yet. When you are, we think we're the group to take it down. Here's our track record, and we'd love to have the conversation with you more. We've run into some weird situations. We don't need to get into it too much now on those, but we're attempting, and it's not going to happen on the first few. I think repetition and it's a numbers game, and I think we'll connect on a few of those. So there's a couple assets that we really want, and we've been doing it like that. But even to Gino's point earlier, it's a team sport. You got to have those great broker relations, and you have to be a closer and do what you say you're going to do. Because in many deals that we've done, we've done multiple deals with the same seller, and that's because we've closed and we've done the right thing on the front end, and then they've come back to give us repeat business. So
I think, Matt, the other thing you can do is start your own meetup. We've had a lot of students who've started meetups. It postures them up, and also invite out real estate brokers, invite out other investors out there, and a lot of our students have gotten deals through their meetups. It gives them the credibility, it gives them the practice, and it's just a great way to network. So if you don't create your own, go out there and just go to other people's meetups. And listen, we're on a podcast right now. Down the road, 6 months down the road, create your podcast, start out there. You put that in your credibility book. It'll give you that difference. You're always trying to differentiate yourself. And I love the podcast for multiple reasons. You're meeting great people. You're networking. You never know who you're going to speak to. And I think the last thing is we've gotten deals from our title company. We've gotten deals from our banker. So anybody in the market who's in the business will know other people who have assets who are looking. Property management companies are another one. If you talk to a property management company, they usually have some owners that are suffering, that are thinking of selling. Go to a property management company, say, hey, we're here, we're looking to buy. If you have anybody down the pipe, let us know.
One of the things that I'm taking away from what you guys are saying, and this is really how I built a lot of my single family business and portfolio, was looking at the relationship side of things in what I call the crock pot mentality versus the microwave mindset. And we all know, hey, yeah, the microwave is the low-hanging fruit, but really the goodness is in the crock pot. And when you're talking about relationships, right? I mean, this is it's a timing thing. It's people getting to know, like, trust you, see if they align with you, see, if you're the real deal, you're not all hat, no cattle. And a lot of people want that low-hanging fruit. So I love what you guys are really nailing and emphasizing down of going, this is just a timing thing. We're just going to keep adding value. We're going to keep connecting with people. And when that timing is right, we're going to bank on the fact that we've been repetitious enough to, earn that trust and at least that opportunity to be in the conversation, right?
Mm-hmm.
And the reason is because if it don't cash flow, let the grass grow. Because, man, there's a lot of shit deals out there, man. If it's not going to make you money, just get away from it, because it's going to be a headache. And it's going to like suck at your soul. So you got to make sure you're doing good deals.
Yeah, and I want to get to that real quick in some of the pitfalls that you guys have seen with multifamily investors, new entrepreneurs, or even seasoned syndicators and people that may be doing some stuff that might be a little maybe dangerous or sketchy. But you talked about this being a team sport. And for those that maybe think that you have to have some massive company with 10, 15, 20 employees to do these deals, how lean can you really run when you're talking about some multifamily and building the right team, not necessarily on, your payroll, but aligning with the right strategic partners for being successful in this space?
So let me back up, because one thing that you brought up that I think is going to be very interesting, and this is just a FYI for folks to watch out for going forward. I think a lot of folks out there are raising a lot of money. There's a shit ton of money, getting pushed into the space.
Yep.
They're the folks that are there. A lot of guys are doing the deals. They're over raising because they're looking at CapEx renovations, right? And what you're seeing is they're guaranteeing the 8% pref. And they're paying out of, and it's probably in the operating agreement, so it's not illegal, but what you're seeing is those payments that are coming back are actually coming back out of the investor funds that were put in, not true necessarily CapEx. You follow what I'm saying?
Yep.
So like say the property used $10,000 in renovations for the month, but the monthly draw to investors hit their 8 pref, let's just say, is 20. Well, they're paying out that 20,000, but it's basically the investors paying themselves back as they're trying to push the property up. So I think that's one thing that you really want to look for if you're an investor right now is, are you paying me truly based on the returns of the property and appropriately labeling CapEx, or is money just getting swashed around and thrown back at people? Not Ponzi, but they're basically getting paid back with their same money. It's not like they're doing it to hopefully paying out other investors with it, right? It just makes me nervous, some of the deals and some of the things that I've heard going around in the space. And I think that's going to be one of the things that folks really want to watch out for from the LP side. So if you're an LP investor, you're investing with other folks, try to really drill down in terms of how the returns are going to be paid out. Because it's probably written in the operating agreement, which doesn't make it illegal. I would just be very cautious, if I was putting my money somewhere else in terms of how that was, getting paid back. Now, to answer your question, how lean can you run? I think there's a tremendous world of opportunity out there right now with virtual assistants and creating a strong team of what we would call vendors. Different attorneys on the team. You could associate with property management folks that have a great track record, and you could operate from an asset management perspective and maybe have a few people actually on your team. You could sub out accounting. Time and time again, we've taken the reverse approach, and we've kind of taken everything in-house for economies of scale to make sure that the people on the team are aligned with our values. And really, because things are very expensive right now, we utilize those economies of scale to really push down our costs as well. And we have some great folks on the maintenance team that do a complete kick-ass job, and I know go far above and beyond what your normal management team would be able to pull off. We basically have a renovations team in addition to our basic management team, where if something went wrong, it might be a $10,000 bill to sub it out. We're able to take that down in-house. So I think that you can go as lean as you want, but there's going to be costs associated with that.
Matt, I would just tell everyone to be careful and, not pencil whip the deal, which basically means you're forcing the deal. Be careful with your assumptions. Rents aren't going to increase 7% for the next 5 years. And, you just have to be really conservative. And that's why we've lost on a lot of deals. What's making this environment really great is the debt. I mean, real estate is debt and taxes. when you can get a 3.6% interest rate, 5 years of interest only, 10-year term, 30-year AM, I mean, that makes a lot of deals work. That's why people are overpaying on them. So that you have to worry, you have to concern yourself with. Just be careful with people out there making these unrealistic assumptions going forward, and these cap rate exits. It's a scary thing. I think people just have to understand, when you're looking at a sponsor, what is their exit strategy? See, for us, we have to be flexible. We want to buy the deal. We'd like to hold the deal long term. That's why with syndication, it's a little bit harder to hold long term because you're beholden to investors. So you have to look at that. You may be able to refi some of the money and give it back to them. So you have to worry about what we call the 3 pillars, which is market cycle, that debt, and the exit strategy. And I think you have to look at that, whether you're doing single family, I mean, any type of real estate, but I think those are really important. So when you're buying your own deal, Jake and I were buy and hold forever. That's what we wanted to do. But what happens is when you've built up so much equity and you can put that and repurpose it into somewhere else, and that's what's going on with the 1031s and all. That's why these things are elevating, because people have a lot of gains and they're trying to roll it into something else, and they're overpaying. So for us, we sold a couple of deals, money's on the side, and we're looking for other stuff. So just be on the lookout for syndicators who are really aggressive with their assumptions. That's what I would say with that.
Yeah, especially with where we're at in the market right now. Things to be cautious of.
What do they say? Devil's in the details.
Devil's in the details for sure. And that really goes with any, I think, principle in life, right? So somebody comes across a great deal, because there are those needles in a haystack. There's always a bull market somewhere, right? They go, okay, I got a great deal in my hands. One of my first mentors always told me, you find a great opportunity, the money's going to find the way to the deal. And that's really always, I found that, strategy and principle to be true. What are some of the best ways, or maybe we can reverse back to you guys, going from, hey, we were in our W-2 jobs to we got this 25-unit property. How do you recommend somebody go about raising capital and funds for their deal?
Well, that's the first thing every investor needs to do. And that's what we did for our first syndication. I think that's why it took us a long time. You need to find the money before the deal, believe it or not. Because if you're doing a 506B and you only have sophisticated investors and you can't go out to the world and say, hey, I've got a deal. You may have a great deal, but you can't show people that you don't have the substantive relationship with. So when you get off the podcast, everyone needs to create that power base. Who are your people that family, friends, brother's employer, whatever that is. Start creating your credibility book once again, and start reaching out to them, letting them know what you do. And coincidentally, while you're doing that, start looking for deals. Doing both at the same time is going to really benefit you. And for us, after our first live event back in 2017, we just pitched it to them. We said, hey, you know what? We're investing. We're trying to build our base. I remember we had 175 people on our investor portal. After that event, we had over 200. Wow. We needed to start reaching out to them. So that's why we created Rand Partners, and we brought a fourth partner on named Dylan, who took care of that aspect of it. On the call with all of them. I mean, in the past 2 years, we've probably added another 500 or 600 investors onto that portal. They need to be cultivated. They need to be reached out to. We need to create webinars with them. We need to create phone calls with them. When you're, talking to a potential investor, you need to know what their goals are. You really need to learn about them. And that takes time. It's a 20 to 30 minute phone call. It's a follow-up. It's an email. It's a newsletter. All that has to go into it. You have to look at that as a separate business. So for us, we didn't do that in the beginning. We just bought our own deals, but you can incorporate this and start doing that when you start out.
Yeah, I want to touch on that a little bit too, because I think what I've seen in my experience is it's all about the community. And this is not a shameless plug for Jake and Gino. There's multiple communities out there. I think you vet people and you decide who you want to be with. But, I see time and time again where we do different, what we call money mixers and boot camps, and on all these property tours, what happens is people are literally creating partnerships, lifelong relationships, and business deals. And it's just you're amongst like-minded individuals. It's not, I'm in my hometown and all my buddies are out drinking and they don't give a shit about me investing in real estate because they think it's a pie in the sky. You're with people that are right in the trenches with you, and they're making it happen. So I think aligning yourself with the right folks in the right community is going to make a world of difference. Fortunately for myself, I was aligned with Gino, and we were holding each other accountable. You got to find that accountability factor and I think really a community, because it is a team sport. And then basically it's going to accelerate you so much faster, because people in the community are going to know, hey, we like to use this guy for cost seg. This guy's great for insurance. And it just makes the process so much easier, because starting from scratch and trying to, bake a cake and not knowing what the hell you're doing is a bitch, right? Yeah. So that's why we just leverage knowledge and information to accelerate our journeys.
I've always said,
You know that also, Matt, from GoBundance. It's not about the training videos. It's really about meeting people, creating that network and saying, hey, I've got a great deal. What do you think about this? Even asking them for advice, leveraging their vendors, leveraging the people they know, and getting on those mastermind calls and saying, wow, I never thought about that. Hey, Jake, I've got a problem here. This employee stiffed me. What should I do? And we talk about things all the time. And everyone
I was going to go like roughneck, but Gino's saying, no, man, you got to chill out, bro. All right? So it's like, he kept me out of jail, man. He's keeping me out of the stripes. So that's my
go
boy.
Cupcake and little boy voice, right?
Yeah, he's like, no, man, you gotta pivot. And like even today, like before I came here, I was over at the office, and the coolest thing about our community is that we have our whole syndication team there. We have the Jake and Gino community, and like students are coming into the office and just kicking deals around with guys in the office, and they're underwriting them and looking at them. So it's just, I'm telling you, man, it's the community that is so strong, and I think it makes the world a difference.
I think it's one of the most underrated life and business hacks on the planet. And mind you, people are picking up on it more, and it's becoming more of a talked, mainstream topic. But my best, hacks of skipping levels or tapping into opportunities or getting into opportunities that maybe I hadn't earned the right to be in yet were because of my community, who gave me the confidence or the resources or the support or the feedback of what not to do to avoid mistakes. Like what you guys were talking about, that is something that I think a lot of people, they balk at a price tag on a coach or a mentor or community. And
dude, if you're balking at a price tag in multifamily, good luck taking down a $20 million deal at some point, right?
Exactly, right?
So,
yeah. And, I know you guys have a really great education platform, a really great community. I don't bring too many people on in the space that I don't believe in. And knowing your guys' track record and resume, you guys are doing it right. Integrity, ethics, you're teaching people. You've obviously walked your talk. What do you think makes you guys, your community, different at all?
Yeah, no, I want to take this because, my day-to-day is spent many times with the property management, and I'm doing things like this with Jake and Gino, and I'm at the events. The thing I give Gino the biggest props to is that there's an application process to get into the community, and not everyone is accepted. And it's not because we're mean. We just want to make sure that, look, if you don't have any liquidity right now and you're in a tough spot in your life, we'll try to give you some free resources, and we want to get you there. But there has to be a good fit. There has to be the right motivation, and we just try to keep a very sound, tight-knit group of people that are like-minded. So I think it's kudos to Gino on the front end to making sure that everybody that's coming in has been vetted and went through the process. It's not just, hey, we're going to go up and try to rack up as much debt on your credit card as possible. There's a lot of people that aren't good fits, and there's a lot of people that we turn down. So I think it's that integrity of the business, because there has been some folks out there, and I don't want to name names, but in the education space have given it a bad name. Right. And our number one business is owning and managing multifamily real estate. And we do it very well. So we're open to share that information, and we love the community that we've created. But I think for us, it's making sure that someone's going to be a good fit, and not just trying to force it, or do some kind of seminar where you're blasting and it's just, hey, run to the back room, let's rack up $50,000 in a credit card. We don't even have that kind of prices, number one, because it's just not aligned with our values necessarily. So it's I think it's just different. But
I think for us also, Jake, being financially free and not having to do the education as a business and wanting to help people has actually allowed us to attract a better quality. Our personas, mid-40s, 30s, married, or younger, and just wanting to make it happen. So for me, I'm financially free. If I don't want to work with somebody, I tell Josh, please don't sign them up, because they're going to be a drag on us. They're going to be a drag on our community, and they're going to self-select. They're going to fall out anyway. You can't have that
toxicity. Yeah.
Yeah. And for us, I always tell Jake, and I always tell the group, I don't want to scale just to scale. I don't want to grow just to grow. Revenue is vanity. Profit margin is sanity, and cash is king, right? So you can be grossing $10 million a year, whatever, but what is your net? We always worry about top line, but let's worry about the expenses. And for us, we've been able to grow. We've been able to add tons of team members. We've been able to do a ton of these events where it costs a lot of money, and the fulfillment is there, but we have much more quality people, and they're able to take action. And that's what you need in multifamily, and they will create that community and that environment that fosters that, just adds fuel to the fire. So for us, it's just been true to our cores. We have our core values. We have our mission statement, and we just try to live that every day. People
and
first.
we suck at marketing. If we're being honest with ourselves, we suck at marketing, and we're great
Good
at
real
fulfillment.
estate investors, not the best marketers.
But exactly, we suck at marketing, but our fulfillment is badass. I mean, we have accountability coaches, we have deal expert coaches. Gino does business blueprint sessions with people on the front end. So it's and we both attend the boot camps and the live events. So it's and we teach a weekly class. So it's like we give till it hurts. So it's very important that we fulfill, and not everybody's a fit. So I think that's sort of the uniqueness of the community there.
Well, I would definitely say your guys' track record and reputation, stands on its own, and really appreciate the value you guys add to our space and just the integrity you guys add to our space, because we all know that, there's bad apples in every industry, right?
That's
but
right.
There is, obviously that sometimes stigma that goes along with real estate investors and big for-profit type business models. For people that want to know more about your education and all the great content free that you guys offer, and obviously some of your higher ticket paid programs and opportunities there, as well as maybe some of your deals, where's the best place for them to check out what you guys got going on?
Yeah, so I think the easiest way, and I got the B here, the Honeybee book we just wrote, but I think the easiest way is go to jakeandgino.com/honeybee. It's jakeandgino.com/honeybee. And there we have, free downloads. As Gino touched on the credibility book, you're going to be able to get ours. And if you want to take it and rip, R&D, rip off and duplicate, have at it. We want to make sure you guys are successful. We got free Honeybee resources there. Gino did a great job. And you can also apply to work with our team. Again, it's not for everybody. Not everyone's necessarily, going to get in. But also if you want to invest with us, it's all there. So I think jakeandgino.com/honeybee. We can,
We'll be sure to include all those links, resources, stuff we've talked about in the show notes at millionairemindcast.com. Final few questions for you guys. What are some of the emerging markets that you guys might be paying attention to that maybe you don't want to tip your hat off completely to, but
no,
people are...
Yeah, it's actually really easy. So we're a little bit different in terms of, we're always looking for that path to progress, but because we're vertically integrated, we're looking, and we're actually geographically in the sweet spot. We're in East Tennessee, and we love the Southeast. Everyone says, where do you invest? We say the SEC, right? We're in the Southeastern Conference. We're aligning ourselves with those folks. But realistically, we're looking at a 4-hour radius around Knoxville into, cities that are growing. So we have a huge footprint there. We can hit Georgia, Atlanta, Chattanooga, Nashville, Lexington, Carolina. So we're just fortunate to be and blessed to be in a great spot. North Carolina, South Carolina, it's all right there. We're in Charleston the other day. Unfortunately, there was a deal we were looking at, and people have heard of White PECs or NIBCO PECs. Company's been sued. There's class action. Beautiful brand new deal. We're in love with it, but the PECs was failing. And literally there was moisture, and they were trying to patch it with dehumidifiers. Fortunately, we have this, phenomenal team that goes in and looks for everything. And they found that on the front end, and we had to walk away from the deal, but better than getting yourself into something that's going to cost $500,000 to repair. So look out for the White PECs, look out for the NIBCO PECs, because it's bad. And but we love the SEC. We love being next to Chick-fil-A and Kroger's, because that kind of is a great opportunity to let those guys do the data first, and we can backfill and verify it.
Kind of ride some coattails there. What are some of the markets that you guys are just not too excited on, or maybe telling people
we don't go above the Bible Belt, right? we stay out of New York. Now, we're both from New York, so we hate on it a little bit there. But I mean, as you can see, there's certain laws in place there that are unfavorable to landlords. Rent control and these things that are doing, forcing people to pay broker fees, and it just, we like business friendly climates, and our whole blue ocean strategy is to have phenomenal customer service on the property management side or on the education side, and so it doesn't necessarily align with our values to be browbeaten and whipped with rules and regulations. So we like to operate in an ethical way, on our terms, not someone else's. So.
Final piece of advice you guys have for anybody that wants to take that next step in multifamily investing, get started with their first opportunity, whether it's operating and or, as an LP, what do you say to them?
I say education times action will equal your results. That is the success formula for multifamily. But then once you're in the game, that gets you in the door people, systems, and culture. After that, it's like any business. You got to have really good people on the team. You got to systematize. I love Ray Dalio's work. We do top grading now for hiring, but also the Rockefeller habits, scaling up. I love all these systems books and making sure you have a great culture. Gino talks about the sniff test, on the front end, whether it's employees coming in as well. You want to be able to, relate to the person. They want to core values at the end of the day. They need to align with the core values of the company, or it's not going to work out well.
Gino, you got any final thoughts, brother?
Well, for me, it's weird because when you start off as an entrepreneur, it's the I'm a mentality. I'm going to do this. I'm going to do that. And it's really hard because you have to do everything. You have to learn everything. But as you start scaling and getting 50 units and 75 units and 150 units, then 200, then 400, it's time to let go. And that's the hardest part of being an entrepreneur is where when do you let go? When do you make that next hire? When do you implement that system? When do you start scaling up? And it's as soon as you can. And it's hard because we made that mistake. We held on a little too long, and everyone does that. You don't know when to hire the next person, but I will guarantee you when you're thinking about hiring that next person, I'll give you a perfect example real quick. Podcast. Jake was editing the podcast for 2 years. Why did he do that for 2 years? He should have done that for 2 months.
It got so much better when I got out of the way too.
Yeah, right.
But I mean, that's a difficult thing. So for entrepreneurs, don't be afraid in the beginning to do everything. But then after that, start scaling up and don't be afraid to share part of the pie. I think that's what we ended up doing.
Hire good people.
Yep.
Yeah.
Appreciate you guys. Jake and Gino, thanks for coming on.
Thanks, man.
Thanks, Matt.
Awesome show. Thank you, man.
Well, that wraps up this week's episode. Hopefully you enjoyed that interview and got some massive value from it. And if you did, be sure to share on social media, share with a friend, a family member, anybody that can get some value from this, as well as leave a review in whatever platform you enjoy listening to this content on. If you are watching this on YouTube and you're not subscribed yet, hit that subscribe button, as well as drop me a comment below. Let me know something that you enjoyed from this episode. And if you haven't headed over to go.millionairemindcast.com yet and entered our monthly contest and giveaway of over $1,100 in prizes, be sure to do that. It's free. And if we haven't connected yet, if you haven't hit me up, be sure to text me at 844-447-1555. Yes, I answer each and every one of those texts, and I love getting to hear from all of you guys, the listeners around the entire world. Last, if you haven't checked out some of our free tools and resources and the amazing things that we make available to our entire Millionaire Mindcast family, check out therichlifeacademy.com and know that if you want to get in closer proximity, I'm going to be hosting some of our first events this year. Now more than ever, especially with what is going on, is the time to double down on your relationships, to skill up, to surround yourself with other hard-charging people, because we are going to see this landscape of business and life change, and you want to be surrounded by the best of the best. So if you want to check out more information on our upcoming wealth camps, you can text the word wealth camp, one word, to 844-447-1555. And if you want to be directly mentored by me, this is a one-on-one mentorship. Text the word mentor to 844-447-1555 to learn more about what it entails and how you can work with me directly. With that being said, keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers, my friends.